1 million ounces. That is the number you need to hold in your mind for the next 18 minutes. Because starting this Monday, China is moving 1 million ounces of silver, and the Western price you are watching on your screen right now has absolutely no idea it's coming. The paper price says one thing, the vault says something completely different. And the gap between those two realities is about to become the most expensive education retail investors in the West have ever received. Let's talk about what is actually happening right now in the Shanghai Futures Exchange. Because if you are watching silver on COMEX, on Kitco, on your brokerage app, you are watching a shadow. You are watching a number that a group of institutions in Chicago and London have agreed among themselves to call the price. But in Shanghai at this exact moment, physical silver is changing hands at a premium that has never existed at this scale in the modern era of precious metals trading. And Monday is when that divergence stops being a footnote in a Chinese derivatives report and starts being a crisis on the COMEX floor. Here is the number that should stop you cold, 29, 14%. That is the premium Shanghai physical silver was commanding over the Western paper price during the last major coordinated move. While COMEX was printing $78 on your screen, real physical ounces in China were selling for $100. Not 79, not 82s, $100. That is a $22 gap on a single ounce of silver, and the premium has been growing for 12 consecutive months, not holding steady. Growing, the Shanghai premium on physical silver has expanded by 1,074% in 12 months. If you've been watching the paper price and feeling confused and wondering why silver keeps getting slammed every time it looks ready to break out, this is why. This is the mechanism. This is how it works. And the Monday delivery window is when the mechanism breaks. But that's not the part that should concern you yet. Let me show you the actual vault numbers first, because once you see what is sitting inside COMEX right now, the Monday delivery cycle stops looking like a routine settlement and starts looking like a structural impossibility. COMEX currently holds approximately 294 million ounces of silver across all registered and eligible categories. That sounds like a lot until you understand what it is actually backing, because paper silver contracts outstanding on COMEX at any given time represent the right to claim physical delivery on demand. And the ratio of paper claims to real deliverable silver sitting in those vaults is not 2.1. It is not 10:1. Right now, in April 2026, for every single ounce of silver that actually exists in a COMEX vault, there are over 300 paper claims sitting on top of it. 300 paper owners for every 1 real ounce. Wall Street is not confused about this number. They know exactly what this means. They have always known. The entire paper silver market is designed around the statistical certainty that the overwhelming majority of contract holders will never ask for the physical metal. They will roll their contracts. They will cash settle. They will take the fiat equivalent and walk away. The system depends on that behavioral compliance, and right now China is about to violate it at scale. Now, if you are new to this channel, what you are about to see in the next few minutes is the kind of institutional positioning data that does not make CNBC. It does not trend on financial Twitter. It gets filed quietly in the pre-dawn hours in regulatory documents that almost nobody reads. But we read them, we track them, and what just appeared in the Shanghai Futures Exchange positioning data for the week beginning Monday, April 28th, should be making headlines right now. And here's what should concern you even more than the number itself. It is not. Nobody in Western financial media is covering this. Not a word. If you want to stay ahead of the moves they don't tell you about, and you are watching this channel for the first time, you need to understand that the information asymmetry between institutional players and retail investors is not an accident. It is a feature. It is engineered, and the only defense you have against it is showing up before the move, not after. So, if this kind of pre-event analysis matters to your financial decisions, make sure you are subscribed, because the Monday window is only the beginning of what is building here. Let me show you the positioning data, and let me show you why 1 million ounces moving in a single delivery window is not just a big number, it is a threshold number. It is the number that historically precedes a price dislocation that the paper market cannot absorb. In every major silver price event of the last 40 years, 1980, 2011, 2020, the trigger was not a news headline. It was a delivery demand that the supply infrastructure could not meet on the terms the paper market had promised. The price was not moved by retail sentiment. It was not moved by Reddit. It was moved by physical removal. By someone or multiple someones saying, I do not want the paper. I want the metal, hand it over. And that is exactly what is being set up right now on the Monday delivery cycle. The question is not whether this is happening. The positioning data confirms it is happening. The question is, do you understand what comes after the 1 million ounce move? And more importantly, do you understand who does not? Because the West is still pricing silver like 2019. And the East stopped living in 2019, approximately 18 months ago. Let me take you through the data sequence, because this is not one anomaly. This is a pattern, and once you see it across 5 separate data points, the word coincidence stops being available to you. Data point 1, Shanghai Futures Exchange open interest in silver has been climbing for 11 consecutive weeks, not fluctuating, not cycling the way futures markets normally do, climbing in a straight line. That kind of sustained directional accumulation of open interest in a physical deliverable contract is the institutional signature of a coordinated buying program. Someone, and the scale of the positions makes it clear this is not retail, someone has been systematically building long positions in Shanghai silver futures for nearly 3 months. And here's what makes that unusual. This is happening while Western paper silver was being suppressed, while COMEX silver was getting hit every time it approached key technical levels, while the mainstream narrative was telling you silver was in retreat. The entire time the paper price was being managed downward in New York, the physical accumulation in Shanghai was accelerating. Paper says one thing, the vault says something different. Data point 2, COMEX registered silver, the inventory that is actually available and cleared for delivery, has been declining since October, not the eligible category, which is metal sitting in approved vaults that has not been cleared for delivery. The registered category, the ounces that a short seller is legally and operationally committed to hand over if a long stands for delivery. That number has dropped from 57 million ounces in October to approximately 34 million ounces today. That is a 40% decline in deliverable inventory in 6 months. Nobody rang a bell. Nobody put out a press release. The number just quietly eroded. One transfer, one reclassification, one withdrawal at a time. Why did JP Morgan reclassify 13 million ounces from registered to eligible in a single filing last winter? When you move metal from registered to eligible, you are not removing it from the vault. But you are removing it from the pool of metal that counts as available for delivery. You are drawing a legal boundary around it. You are saying this metal exists, but it is not yours to claim. That reclassification, 13 million ounces, filed at 11:47 p.m. on a Tuesday, reduced the registered inventory by nearly 23% overnight. Overnight. And nobody talked about it. Data point 3, silver lease rates. This is the canary that almost no retail investors track, and it is one of the most reliable indicators of physical tightness in the market. When physical silver is plentiful and easy to borrow, lease rates sit between 0, 1% and 0. 5% annually? Boring. Flat, institutional background noise. When physical silver is being hoarded, when it is moving out of circulation, when the institutions that are supposed to have it available are quietly keeping it for themselves, the lease rate spikes. Right now, silver lease rates are running between 6% and 9% annualized. 6 to 9%, compare that to the 0. 5% that is considered normal. This is not a small deviation. This is a 12 to 18 times multiple above the baseline. And once you understand the ratio, the price action makes sense. The paper price has been held down precisely because the physical rate is screaming that something is structurally broken. How can 300 paper claims exist for every real ounce? How can lease rates be running at 6 to 9% in a market the paper price is telling you is in oversupply? How can both of those things be simultaneously true in a functioning market? They cannot both be true. One of them is lying, and it gets worse. Data point 4, the Shanghai Gold Exchange, which handles physical silver trading alongside gold, reported something in the last 2 weeks of April that has not received a single line of coverage in Western financial media. Physical silver withdrawals from SGE-approved vaults hit a 4-year high. Not a monthly high, a 4-year high. The last time withdrawals from these vaults ran at this pace was the spring of 2022, just before silver made a 28% move in 11 trading days. The metal is leaving the warehouses. It is not being sold back into paper contracts. It is being physically removed, transported, allocated. It is going somewhere, and it is not coming back. Data point 5, and this is the one that should stop you cold. The Monday delivery window on the Shanghai Futures Exchange has, according to positioning data filed in the last 48 hours, an unusual concentration of contracts standing for delivery. The aggregate of positions seeking physical settlement in the April 28th window, what traders are calling 1 million Oz Monday, represents a delivery demand that would require the allocation of approximately 1 million troy ounces of physical silver in a single settlement cycle. 1 million ounces in one window on one exchange. That is the equivalent of approximately 3% of annual global silver mine production being demanded as physical delivery in a single day. Now, here's what makes this a structural event rather than just a large trade. The SHFE has circuit breakers. It has daily price move limits. And during the last major delivery stress event on this exchange, those limits were triggered, and the limit down price in Shanghai was still $60 per ounce above what COMEX was printing on Western screens. Think about what that means. The floor of a halted, frozen, circuit-broken Chinese market was still pricing silver 16 higher than the freely trading Western paper market. The West is still pricing this like 2019. But this pattern is not new. You need to see where you have seen this before, because history is not repeating, but it is rhyming loudly enough that you should be able to hear it from where you are sitting. In March 2011, silver moved from $26 to $49 in 8 weeks. What preceded that move? A sustained period of physical accumulation in Asian markets, combined with a COMEX registered inventory that had quietly contracted, combined with lease rates that spiked to levels nobody on financial television was explaining. The paper price held artificially flat while the physical premium built underneath it, and then and then the dam broke. The paper market was forced to reconcile with physical reality, and it did so violently and in one direction, up. $49. In 8 weeks, from 26, the CME's response, 5 margin hikes in 9 days. When you cannot stop the price from rising organically, you administratively reduce the leverage available to buy it. You force longs out by making it too expensive to hold their positions. The margin hike is not a market mechanism. It is a suppression mechanism, and it has been deployed every single time the physical reality has threatened to overwhelm the paper fiction. In 2020, during the COVID dislocation, there was a moment when COMEX silver futures and physical silver spot prices diverged by more than $3 per ounce simultaneously. You could not buy physical silver near the COMEX price. The wholesale market was frozen. Premiums on silver eagles and silver bars went to 30%, 40%, 50% over spot. Why? Because the paper price had become completely disconnected from the cost of actually obtaining the metal. The COMEX price was a number on a screen. The physical price was what it actually cost to take delivery. Wall Street is not confused about this. They know exactly what this means. The suppression of the paper price is not an error in the system. It is the system. The paper price is the control mechanism that allows the transfer of physical silver from retail hands into institutional and sovereign hands at prices that will eventually look, in retrospect, like the greatest mispricing in commodity market history. And here's what they filed at a regulatory level that nobody is talking about. JP Morgan's commodities desk, which holds the single largest concentrated short position in COMEX silver among all commercial traders, has been simultaneously expanding its physical silver holdings in custodial vaults outside the COMEX system. They are short the paper, they are long the physical, and that is not a contradiction. That is the trade. Short the paper price to suppress it, accumulate the physical at suppressed prices, and then cover the shorts at your own chosen moment. The premium held through the entire dump. That is the tell. Every time the paper price was attacked, every time silver got smashed on a Sunday night or a London Open, the Shanghai premium not only held, it widened. This number doesn't exist in a fair market. A sustained, growing premium of nearly 30% between two prices for the exact same metal on two different exchanges should not be possible in any market with functioning arbitrage. It persists because the arbitrage is being blocked, because moving physical silver from west to east at the scale required to close that premium would expose the leverage ratio in Western vaults, and that exposure cannot be permitted. Let's talk about what happens next. Not in theory, in practice. Because what you are watching build toward Monday is not just a delivery cycle. It is a stress test of the entire Western paper silver pricing architecture, and the results are going to matter to your savings, whether you own silver or not. Here is the sequence of events that follows a successful 1 million ounce delivery demand on the SHFE. First, COMEX registered inventory comes under immediate scrutiny. When a major physical exchange demonstrates that 1 million ounces can be demanded and delivered, or cannot be delivered, every professional in the silver market begins running the same calculation on the Western vault numbers. The 34 million ounces of registered COMEX silver starts looking very different when the question shifts from, does this number exist? To how many of the 300 paper claims on each of those ounces are going to show up Monday morning? Second, the lease rate spike becomes public. Right now, the 6 to 9% silver lease rate is buried in a specialist data terminal. It is not on CNBC. It is not in the Wall Street Journal. But when a delivery stress event forces price action that cannot be explained by any fundamental narrative the mainstream is running, journalists start pulling data. And when they pull the lease rate data, they will find a number that has been screaming physical tightness for months, while the paper price told a completely different story. What happens to your savings when this ratio collapses? Third, and this is the implication that almost nobody is talking about openly, China's industrial silver demand is not discretionary. This is not speculative accumulation. This is not a sovereign wealth fund trade. China is the world's largest manufacturer of solar panels. Solar panels require silver. The photovoltaic industry consumed an estimated 232 million ounces of silver in 2025 alone. That silver is not being stored. It is being consumed, permanently consumed. It is going into panel lamination, and it is not coming back out. It is not recyclable at scale. It does not re-enter the market. It is gone. The global silver deficit, the gap between what industrial demand consumes and what mining produces, ran at approximately 265 million ounces in 2025. Not 10 million, not 50 million, 265 million ounces. And that deficit is structural, not cyclical. It does not resolve when prices go up, because the supply side of silver cannot respond to price signals the way a normal commodity can. Approximately 70% of all silver mined globally is produced as a byproduct of copper and zinc extraction. You cannot open a silver mine. You can open a copper mine and silver comes out with it. If copper demand is not there, the silver does not get mined, regardless of where the silver price sits. This is not something that gets fixed in a year. This is a decade-long structural supply constraint colliding with an exponentially increasing industrial demand curve from the global solar build-out, and the paper price on COMEX is still pricing silver as though 2019 supply and demand dynamics are operative. The West is still pricing this like 2019. And here's what gets hurt first when Monday plays out the way the positioning data suggests. The leveraged short side of the COMEX silver market. These are not the big banks. JP Morgan's position is hedged with physical elsewhere. These are the smaller, commercial short sellers. The hedge funds running short silver momentum strategies, the commodity trading advisors who shorted the breakdown and have been riding it. These positions are profitable as long as the paper price stays suppressed. The moment physical delivery demand creates a price impulse that cannot be administratively managed, a margin call cascade begins on those short positions and forced buying creates its own momentum. This is the mechanism of the short squeeze. Not retail Reddit-style pressure. Institutional forced buying from margin calls on short positions that were built on the assumption that the paper fiction would hold. Once you understand the ratio, the price action makes sense. The 300.1 leverage in the paper market is not sustainable. It has never been sustainable. It was sustainable only for as long as nobody demanded delivery at sufficient scale to expose it. 1 million ounces on Monday is not enough to break the system by itself, but it is enough to put a crack in it that the next delivery window, get big series, and next series and the one after that, will widen. If you have been watching silver for any length of time, you have seen this pattern of suppression, you have watched the premiums build on physical, you have read the vault data and watched the lease rates, and asked yourself why the price on your screen doesn't match the reality you are seeing everywhere else. Here's what I want you to understand. You are not missing something. You are not misreading the data. The disconnect you are feeling is real. The data you are tracking is correct. The paper price is the illusion. The physical reality is what it is. And the gap is not closing. The gap is widening. If you have been building a physical position in silver, stacking, accumulating, holding outside the paper system, what Monday represents is not a windfall event yet. It is a validation event. It is the first moment where the scale of the physical demand becomes visible enough to register in Western price discovery mechanisms. The actual price event, the vertical move that forces reconciliation between the paper fiction and the physical reality, that comes later. That comes when the delivery stress accumulates across multiple cycles, when the lease rate spike can no longer be ignored, when the Shanghai premium finally forces a capitulation in Western short positioning. But here's what concerns me about what happens to the people who are not paying attention to this. Wall Street is not confused about what is building. They are positioned for it. They are short the paper and long the physical, and when the price reconciliation comes, they will cover their shorts into the move, buying more physical with the profits from the paper position, and they will exit the whole structure wealthier than when they entered it. The retail investor who was watching the paper price and saw suppression and sold their physical, they handed their metal to the institutional buyer at exactly the wrong moment. The premium held through the entire dump. Every time silver was attacked on paper, the physical premium in Shanghai did not collapse. It held, and then it widened. That is the signal that the smart money did not believe the paper move. They watched the dump happen, and they bought more physical. Do not be the person who sold in the dump because the paper price told you to. And here is something I want you to sit with, because this is the part that should produce controlled outrage in any investor who has been told that markets are fair and transparent, and that the price on their screen reflects reality. The 356.1 paper to physical ratio that existed at peak COMEX leverage last winter, 356 paper claims for every real ounce. This number was not hidden in a dark corner of the internet. This number was calculable from publicly available COMEX data, open interest divided by registered inventory. Any financial journalist with a spreadsheet and 40 minutes could have run that calculation and published it as the most important story in commodity markets. None of them did. Not one mainstream outlet ran the story. The suppression of the price story is matched exactly by the suppression of the information story. You are not supposed to know this. The system functions correctly only as long as you do not know this. And now you know it. So let me tell you what you should be watching after Monday. Watch the COMEX registered silver inventory number. If it drops below 30 million ounces in the 2 weeks following the Monday delivery cycle, it means physical removal accelerated. It means the stress is spreading from Shanghai back to Chicago. Watch the silver lease rate. If it moves above 10% in the next 30 days, it means the physical tightness is reaching a level that the paper market cannot continue to ignore administratively. And watch the Shanghai Western price spread. If the premium in Shanghai after Monday remains above 25%, if it does not compress back toward parity despite the delivery cycle, it means the structural separation between the two markets is becoming permanent rather than cyclical. Any one of those 3 data points confirming would be significant. All 3 confirming simultaneously would be a signal that the timeline for price reconciliation has compressed from quarters to weeks. And there is one more event on the calendar that nobody in the mainstream is connecting to this setup, and it changes the risk calculus on the short side dramatically. The next COMEX silver options expiry falls on May 27th. Between Monday's delivery cycle and that expiry, every short position holder in COMEX silver will be making a decision. Do I roll, do I cover, or do I stand pat and absorb whatever comes out of the Monday physical demand event? The concentration of that decision-making into a 5-week window from Monday's delivery to the May expiry creates a compressed timeline where price volatility is not just possible, it is structurally baked in. The institutions know this. They have mapped the calendar. They have positioned accordingly. The question is not whether they are positioned. The question is which side of the trade they are on. Because once the Monday delivery numbers come through, once it becomes publicly visible how the SHFE handled 1 million ounces of physical demand, the May 27th expiry becomes either a controlled event or an uncontrolled one. And the last several times this calendar compression has occurred in silver, you stuck when a major physical delivery cycle preceded an options expiry by 30 to 45 days, the price did not sit still. It did not drift. It moved hard, fast, in one direction. You are watching this because the mainstream will not show you, not because they cannot find the data. Because showing you the data changes your behavior, and your behavior collectively is what the paper market depends on. Your collective willingness to accept the paper price is real, to sell your physical when the paper number drops, to never stand for delivery, to never pull the metal out of the system, that is the compliance the leverage ratio requires to function. The moment enough people stop complying, the moment physical demand at the delivery window reaches a scale the paper architecture cannot absorb, the entire pricing structure has to reset. 1 million ounces on Monday is not that moment. But it is the moment when the reset becomes visible on the horizon. And here's the question I'm going to be sitting with between now and May 27th. The question I cannot fully answer yet, and the one that the next video in this series is going to go deep on. If the Monday delivery cycle confirms what the positioning data is suggesting, if 1 million ounces gets demanded, and the SHFE settlement strain shows up in the data the way the last 3 delivery cycles have progressively shown more stress, then the May 27th COMEX options expiry becomes the first Western price event where the Eastern physical reality cannot be entirely quarantined from the paper price discovery mechanism. The question is not whether the West will eventually price silver the way the East has been pricing it for the last 18 months. That reconciliation is already written in the structural data. The question is whether May 27th is the date that reconciliation becomes unignorable, or whether there is one more cycle of suppression left in the tank.